All right, now we got to talk about the Federal Reserve. What is going to happen on the 22nd? What is Jerome Powell going to do? What are markets pricing in? And what do we think? Well, it's a coin toss right now, and markets are going to flip-flop a lot on Monday and Tuesday, but I think what's most important is that we actually take a look at the S&P. Now, we haven't looked at the S&P in a little bit. It's been a hot minute, but what we're going to do right now is we're going to pull up the S&P that we got last in December. Now, keep in mind, the S&P from December is not the most recent analysis from the Federal Reserve, but we're going to get a new version of this on the 22nd of March. And we're going to go through it with a fine-tooth comb because I believe that is going to be much more applicable than what the Fed actually does with their rate move. I think we're probably going to get a 25 BP hike. I think a pause would signal too much stress in the banking system. I think a 25 BP is a sign of confidence that, no, we're strong. We're going to continue to fight inflation, and we can continue to do so even though we're panicking in the back end and printing money like crazy. We're going to continue fighting inflation, and therefore we're going to raise rates 25 BP. This is despite the fact that Elon Musk says that the Fed is operating with way too much latency in their data, and rates need to drop immediately, Elon Musk tweeted yesterday. But let's look at the S&P. Excuse me. All right. Okay, so S&P is right here. This is the last summary of economic projections. Now, what I want you to remember is this was released on December 14th. When the Federal Reserve conducted their last FOMC press conference, they told us that they expect that this S&P would have actually been higher if they had to go back to their February 1, if they had to write it February 1. So come February 1, the Fed would have written this S&P more aggressively than what it was here. However, now we actually expect it to be written down. Now, how could it be written down? Well, we'll take a look at that. First, we have to remember that inflation is sticky. That is something very important. So let's go ahead and start with this chart before we look at the S&P. So let's pull it up like this. Okay, what I want you to pay attention to are the trends here. So first, I'm going to go ahead and draw. Let's go ahead and do a big red. Okay, yeah, perfect. Okay, so the first thing I want you to pay attention to is this trend right here. So you see this trend that I drew right here? Okay, that was a problem. And that trend continued to about June of 2022. See that trend right here? That is critically important. The reason that trend is critically important is because that trend is a Paul Volcker style trend. That trend right there tells you you're screwed. Get out. Do not be anywhere but cash and maybe even gold because we're going to hell. That trend is the death of markets. That trend is what a wage price spiral looks like. That trend is the end of the financial markets as we know it. Fortunately, that trend has stopped. And we expect that trend, we're going to look at the new trend in just a moment here, and then we're going to look at the S&P, but I want to be very clear about that. We are not in that kind of trend line anymore. What do we know in a consolidated 30-second pitch? No, not for life insurance or 12 free stocks or for the courses linked down below with the expiring coupon code linked down below. But in a 30-second pitch, what do we know about the market where it is now? We know the supply of labor is higher. We know there is no wage price spiral. We know that, yes, wages have caught up to levels where they should be, which includes some lingering price hikes, but companies are taking it in the margin. We know companies' ability to just raise prices is gone. That's over. We are not seeing the conditions of a wage price spiral, period. That means less chance of a Paul Volcker from a wage point of view. But where is that showing up from a CPI point of view? Consistent as well. The conditions for a wage price spiral are not in labor and they are not in CPI. Look over here. So this is obviously a much more difficult trend here to draw. We could draw a trend right here. We could also try to wedge this a little bit like this. It's a little volatile over here because we have this very large drop. But the point is, this trend that we had of higher highs is over. It's substantially over. We know this is still too high, right? Because the trend right here brings us to around 4 to 6% inflation. It's sticky. It's a problem. But it is no runaway inflation. It is no Paul Volcker. Inflation expectations are falling. Financial conditions are tight and high. This is not a Paul Volcker scenario. So the Federal Reserve has substantial leeway to loosen their summary of economic projections. So let's talk about the summary of economic projections. What's up, Hexflex? Dude, I love that name. I'm a sucker for the rhymes. You know, I who was it with? Sarah Dietschy made a joke the other day. She said her husband, he's from South Korea, and I guess his screen name used to be because his last name's Hill. So I guess his screen name used to be what was it? I can't remember now what it was. Kim Jong Hill, I think he made, or something like that. But anyway, I'm a sucker for screen names. I think that's hilarious. I can't remember exactly what it was, but stuff like that's cool. So what's up, Hexflex? I don't know why I'm going on that tangent. Maybe because the coffee hasn't hit yet, and I really don't want to talk about this boring chart right here. Actually, I do want to talk about it. It just looks very dry, so I'm trying to inject humor, but I'm failing massively. But it's okay. It's 6 in the morning on a Sunday, and I just went to the T-Swizzle concert last night, and I feel dead inside. Anyway, okay. Did park next to her plane, though. That was pretty cool. Okay, that was like, pinch me, I can die. So anyway, what do we have here? Change. Okay, so first of all, I think where we're going to get, and I'm going to tell you my opinion over here, because that's all we're going to go through is really my opinion here. So let's do some erasing, okay? We're going to erase this crap I had drawn last time. And what are we going to have over here? Change in real GDP. So here's what's important. In the December meeting, they showed that their projection for a change in real GDP fell substantially. The concern going forward, I'm going to tell you, this is going to be the most concerning for the stock market. So if you're an investor, if you are a trader, I promise you, the most important, let me just get it out. The most important segment of this summary of economic projections is right here, folks. It's this box. You could really look at nothing else. That's the box that matters, because everything else is going to be based on that box right there. Everything is going to be predicated on this top box. The Fed's expectation for a recession. That's it. And so here's what happens. If the Federal Reserve suggests that we could go negative here, which I do not think they will ever do that, the market will crash. Instantly, the market will crash if that number goes negative. I do not think they are going to do that, though, because this is a tool. This is not what they actually really likely think is going to happen. It's a messaging tool. It's to try to manipulate the market to do what they want it to do, okay? It's a communications tool. It's a joke. That's all it is. But that's okay. It's a communications tool that's really never accurate, but the messaging of it will affect traders, at least in the short term. So where could the messaging be dangerous? They're not going to go negative here. What they're going to do, in my opinion, is they're going to lower this right here. Hi Lauren, that 2024 number, I think they're going to revise that down, and potentially, although I don't think they go under 0.5 ever, if they went any under 0.5 over here, that's another recessionary indicator, but I don't think they're going to do that. I think that 0.16 number potentially could go down, so I'm going to write my bet, okay? I think that number could go down to 1.0. Come on, silly little chart thing here. There we go. If that 1.0 number over here goes down that 1.6 number goes down to about 1.0, I think the market goes red. I think the market will be very nervous, and that's because the markets don't care so much about inflation anymore right now. They care about a recession, and that is a recessionary indicator. And so that is a recessionary indicator that markets are going to be a little pissy about. In addition to that, the 2025 number, I'm not so worried about. I do think the longer run, they'll trend towards that 1.8, and that's so far away, nobody really cares. But the question is, are we going to see that 5-quarter recession that the Goldman Sachs and T.S. Lombard were talking about yesterday? Yesterday, we covered in our reports that there's a potential for a 5-quarter long recession. That 5-quarter long recession could begin as soon as, that would be the third quarter of 2023 and lasting basically through 2024. If the Federal Reserve agrees that we could be seeing a 5-quarter long recession, they are going to revise down that GDP figure on their SEP. Personally, I believe that is the most important segment of this chart, and it's one that you really want to pay attention to. Now, the next thing we're going to do is let's look at the rest of the chart here. Let me see. Okay, here we go. And remember, this meeting is on the 22nd, so you really want to pay attention to what's going on the 22nd. Okay, dokie then. So the next thing, this unemployment rate. Now, this will be interesting. So I want to see if the Federal Reserve actually thinks they can get this number up. I don't think they're going to change the unemployment rate much for 2023, but I would not be surprised if they adjust this 2024 number and this ends up being a 5.5. So I would go 5.5 right here. Those are going to be my, like if I was at the Fed, this is what I would do. I would be real right here. I'd go 5.5 for the unemployment rate. I would expect a big tick up over here. I'd go GDP down to 1%. Now you're sending real concerns about a recession. Then what you're going to do, in my opinion, is for this rate trajectory, let's erase all this crap over here. Those are the last notes that we made. And remember, I don't delete videos. You can always go back and look at the stuff I said in the past. I actually think that's a really cool thing because then we can kind of compare to the past stuff. But so that's why I'm erasing that now, is because it's all in old videos anyway. So Fed funds rate, what do we have over here? We've got a projection of 5.1. Okay, I don't think we're going to hit that anymore. We're not going to get to that. So this is probably going to drop to my previous belief that we were going to hit about 4.8. That would probably be like a 4.75, which would probably be consistent with one more 25 BP hike, and that's it. I don't think we're going to cut this time. I don't think we're going to pause this time. Give us one more 25. That'll signal a 25 or a 4.8. Now, this could really balance the market potentially going red on Wednesday. What could balance it is this number right here, 4.1. Is the Fed potentially by the end of the year, next year, by the end of 2024, are they potentially going to signal large cuts by the end of the year, beginning of next year? 4.8 over here is probably, I don't think they're going to want to signal cuts at the end of this year, even though the market is pricing it in. They'll want to show, no, we'll be strong, even though they probably will cut by the end of the year. I think this number goes down probably quickly to 3.5, and this number over here probably to 2.5. Pretty quickly. And those are the 24 and 5 numbers for the FOMC rate projections. So I think you're going to get a slash next year in the projections over here. And I don't really think this inflation projection matters much over here. You could actually possibly see the Fed come in over here, and you could actually see them raise this to, let's say, 3.8 to signal that they're okay with more stickiness. So in other words, I wouldn't be surprised to see the inflation numbers actually come up, the GDP numbers to come down, and the rate numbers to come down. That'll be enough of a signal that the FOMC is okay with slightly stickier inflation and a higher for longer trajectory. As a result, though, trending closer to recession and more unemployment. Now, one of the analogies that I was reading about this morning, I wake up too early. I'm sorry. I really do feel very tired. But one of the projections this morning. I thank you for somebody donated $20 talking about somebody bought a house for $10. What do you in, like, Detroit? If you want to see me go house hunting in Detroit, I did that years ago with Graham Stephan. You can actually type that into YouTube, Meet Kevin Detroit. You'll see it was a great video. But anyway, one of the things I was reading about this morning was this idea that people like to think of the Federal Reserve raising rates as sort of tapping on the brakes. But that's actually a false analogy. The Federal Reserve isn't tapping on the brakes. What they're really doing when they raise rates is they're pulling a rubber band. But everybody basically keeps spending like normal and everybody keeps acting like normal until something breaks. And that breaking is not hitting the brakes. It is the rubber band snapping. And that's what we're seeing with the banking crisis. And so the problem is we don't really know what the long and variable lags are of Federal Reserve monetary policy, because they kind of hit you all at once. And that's one of the problems that we're going to face, and we're going to hear a lot about, I think, with the FOMC during the Fed's press conference. I think we're going to get a lot of, hey, like, we have to be careful. And I think it would be very good for Jay Powell. And I don't know that he watches me. He probably doesn't. It would be really flattering. But if I could talk to Jerome Powell, I don't actually think he does. But if I could talk to Jerome Powell, and I think he knows this, I think these projections are reasonable. And remember, every individual at the Fed makes their own projections, and then they sort of average them, right? That's why when you look at this, you could actually look at the central tendency on the right, and you could look at the range over here on the far right, and you can kind of see where all of their heads are, how low are people, how high are people. Anyway, if I could talk to Jay Powell, I would probably make projections like that, but I would probably suggest doing as much as possible to talk about, in a transparent manner, how mindful they want to be about the lags of monetary policy, and how the fact of the matter is they just don't know what the lags are. Is it an 18-month lag? Is it a 6-month lag? Is it a 2-month lag? And how do we feel that lag? Is the lag instantaneous, like a rubber band breaking? Or is it a breaking of the economy, like in the way that you kind of you take your foot off the gas in a car and then you slowly tap on the brake, right? And if it's possible that lags are more of a oh God, they're all happening at the same time, then I think it's important for the Federal Reserve to be transparent about that potential, right? And so I think if Jerome Powell takes some more time during this presser time, or even if a reporter is listening, please, somebody who's in that press room, ask about, is it possible? Like this, if I could ask a question, I mean, I'd have a whole host of questions. But if I was on the spot right now and being asked, hey, what would you ask Jay Powell in that presser? Say, Jay Powell, can you, just as transparently as possible, go through what does a long and variable lag mean in the effect of, for an average American, how do we feel those lags? Is it by us crashing and hitting a wall? Or do we feel the effects of monetary policy slowly? And then he'll probably go into, interest rates go up slowly, right? Lending conditions tighten tighten slowly. Credit card rates go up, home rates go up. That's how we feel that as an average person, right? And no. That's not what we need to hear. We know that. We need to know, is the banking crisis we're facing the culmination of a policy lag? And how bad is that actually going to get? How many banks are actually going to collapse? Now, of course, there's a limit to how much detail he can go into here because he doesn't want to create a crisis. So I think we really have to think about being jaded in the way that you ask a question, because if you ask a question that you know he's not going to answer anyway, then you've kind of asked a worthless question. But any kind of hints that we can get in Jay Powell talking to us about, okay, yeah, maybe these lags can all come at once and we have to be very careful. Those hints are what I think are going to be eaten up by the market. And it's going to take a lot of thinking about those hints in terms of how we digest those. But I think we're going to get a lot of those hints this time. That's what I think this press conference is going to be about. It's going to be about hints, dropping hints that we're probably going into recession. This banking crisis sucks. A lot of banks are going to go bankrupt. And don't worry, we will turn the money printer on again to bail everyone out. And so what hints are we going to get for the potential Fed U-turn? And that, I think, is the beauty. What hints do we get of the potential Fed U-turn? That is what I am most curious about, the hints for the Fed U-turn. And quite frankly, more insight into that Fed money printer will be very interesting, because that will confirm, is what we're seeing right now, this switch to QE for the week with $300 billion of liquidity injected, is this just a transitory QE, and are we still going to stay on the path of QT, quantitative tightening, or are we going to pause? Remember, the Fed is tightening to the tune of $90 billion a month right now. What if they come out and say 25 BEP, hints that we're basically breaking the rubber band in the presser, higher unemployment and trending closer to recession, and you know what? Because of that, we're going to slow QT. What if they say that? Hey, we're going to pause QT, or we're going to go from 90 billion a month to 45. Well, that's going to be a sign that things really are breaking, right? I don't think they want to send that signal with actual policy change. So I don't think they'll change policy, but I think verbally they're going to give us those hits. So I think they'll stay at 90 bill QT. See, they can still be at 90 bill QT per month, but then actually be running the money printer faster through the Fed liquidity facility. So I don't think they have to change policy. So I'm gonna make my projection. We're going to get 25. We're going to keep 90 bill QT, but they're going to run that money printer as much as they need to help this banking crisis. So nothing's actually going to change except the messaging. That's why we went through the SEP. The SEP is going to matter, and how severe is this rubber band breaking, J-Pow? And I think it's pretty severe, and I think they realize it. And I think we probably are on a path back to QE. And as long as inflation goes away, which it is trending away, I do not believe. And look, I respect Peter Schiff. I really enjoyed my interview with him. I think he is a brilliant person. I do not think that the 2008 money printing, from 2009 on money printing is what's catching up now, and that the COVID inflation is still ahead of us. It was a fantastic argument. You should watch the interview. I respectfully disagree with Peter. And that's okay. Everybody can have a different opinion. That doesn't mean I dislike the guy or hate the guy. I love Peter. I think he's a brilliant person. And he's got a fantastic family. I love them. His wife is so cool. His son is brilliant. His mom is super cool. She is like an OG hustler, man. So cool. I want to interview Peter Schiff's mom, like confronting Peter Schiff's mom. She's got such a cool story. She is like an OG hustler. She made it as a woman where generally only men made it. And it's remarkable. She was like, the analogy I would make is that the power woman in like a Manhattan madman setting. Super cool. But anyway, tangents, Kevin, damn it. But anyway, jeez, where was I? Basically, I don't think we're going back to I do think that this inflation on screen here is going away. And I think the Fed knows that they can take their time. And the reason I know they can take their time is because they've done it before. And I'm not just going to pull my old fate flexible average inflation targeting argument out of the hat again, even though I think they're going to do that. I'm going to pull a new one, okay? You ready for this? I've talked about this before, but it's been a while since we've talked about it. Opportunistic disinflation. Study that. Make that your mission today. Study opportunistic disinflation. By the way, this is the kind of stuff why I think it's cool if you join me in the course member live streams as well, because I do think I have some crazy perspectives that are unique and different. You don't have to agree with me on everything. I think that's why the haters come back and they watch me too, is because it's good to know even people you don't like or people you want to just punch in the face. It's good to know what they think, right? Look into opportunistic disinflation. What is opportunistic disinflation? Well, basically, once inflation expectations were under control in the early 1980s via Paul Volcker, the Federal Reserve took 20 years to get back to 2% inflation. And they did so because they could. Every opportunity they had, every market crash or whatever, inflation went lower and lower and lower. And as long as we do not have a wage price spiral, which we don't, and as long as we do not have runaway inflation, which we don't, and as long as inflation expectations are anchored, which we have, and as long as financial conditions are tight, which we have, the Federal Reserve, all the conditions are here. The Federal Reserve can buckle up under something known as opportunistic disinflation. In other words, you buckle up and you just take your time and you let inflation subside over time, even if it takes another decade, okay? In the meantime, you run the money printer and back to the moon we go, baby. And look, I'm not a moon boy, okay? Maybe I am. But that's what I think.